So Chris Peavy is who you see on the background there. And go ahead, why don't you tell us about some of the things that you have on this?
So a little background on myself. I did get a degree in mechanical engineering from a small school in northern Michigan. I'm originally from the Houston area. My entire family is pretty much from Michigan. The only people that don't live in Michigan anymore are me and my sister. When I graduated from college, I immediately went to work in oil and gas. It turned out to be a good time because everybody knows I graduated in 2006, and right there in 2008, market crashed. Well, Michigan tailors to the auto industry, and a lot of my friends that did graduate with me were without jobs. But I just kept going. You know, I ended up moving out to Wyoming for 6 years, working for Baker Hughes. My wife and I got married. She came up there for about 4 years, and then we moved back to Houston. And she is a pharmacy manager with Walgreens, and still is for the time being. We moved back to Houston about 2012 when we wanted to start having kids. We got two boys, ages 7 and 4. Why did we join Lifestyles in 2015? Well, as most of you know, oil and gas is a very, very cyclical market. It's commodity-based driven, and it, you know, it has its severe ups and downs. Well, in 2014, everything was good, and then 2015 came along, and the market just crashed. I don't know how many rounds of layoffs I watched, but I made it through all of them. But in that time, I wanted to diversify my portfolio and generate another round of income so that I could protect myself and my family from, job loss. And that kind of led me to Lifestyles. And as of now, I am a full-time investor within real estate since February of 2019.
Excellent. Next slide. All right. So how'd you find Lifestyles and why'd you join?
Like I kind of touched on before, I did it to replace my primary income with ultimately passive income, and eventually stop working. And like I said, protect myself from volatility of the commodity-based market, and have financial freedom for a better lifestyle. And the biggest thing I could say for anyone is Lifestyles is the mentorship, networking with other investors, like-minded individuals who help you grow and develop in the correct fashion.
And how'd you find Lifestyles?
I found Lifestyles through radio to start, and I did some fact checking with a couple other people that I know that were high up within oil and gas industry, and come to find out, they were also members of Lifestyles. They kind of dabbled in it, maybe did a couple passive deals, a couple houses, but never really took it to the kind of where I'm at now. So.
All right. Did you do any single family or any passive before you did this first deal we're about to talk
about? I thought about doing single family, but when I saw the upside potential for multifamily and the long-term growth with multifamily, I just went straight to multifamily and skipped single family.
Okay, and we're going to see when we get to the numbers that you also did a fairly high amount, which would have been very difficult to start with single family and get it all active in investments.
Correct.
Okay, next slide. All right, so here's what we're here to talk about. Coral Manor Apartments down in Texas City. This was the first deal. And I guess I should say you had one partner on this deal, correct?
Correct. So we were just basically IROs. We met each other in the 2-day. David was talking about it earlier. We have a 2-day once a month that we go in and kind of indoctrinate everybody and get everybody, learn a certain culture and how we do things from a high level. Anyways, I met this gentleman, Alan, and we became very good friends. We still are very good friends, and we partnered together because to buy, a $1.8 million property, you need to have cash. We had just enough, and there were a lot of people buying in the 10 to 20 unit range, but both of us had full-time jobs, and we didn't want to have to do managing from a day-to-day basis. So we kind of joined forces and combined our assets and bought large enough to where we can afford a full-time manager in maintenance.
Yeah, so
We
this
found
is
this
something.
property in Texas City. It was actually being sold by another Lifestyles member through a Lifestyles broker, and we bought it for $33 a door. We cashed out of pocket just about $600,000. How I got that cash, we took 401k loans because we were both working at the time. You can't liquidate if you're still employed. Both took the maxed 50. That gave us 100, and then we had some other liquid cash from stocks that we sold, and basically piled that money together and closed on this deal. The initial financing on it was about 1.3 million. It was a full recourse debt on both families. Rate was 5.375, and the capital repairs, I can go into that, but we didn't really bring any money out of pocket because it was already a cash flowing asset. We just had to continue to do what we did, and we basically took out of cash flow to do our capital repairs.
Okay, so let me touch on a few things there. First of all, it's just amazing to me when we look at deals that were a couple of years old and we see those 5.375% interest rates, and we're getting in the low threes now on deal. I'm in the process of refining one, and we're getting cash out on the refi, and our mortgage payment isn't really changing because we're saving 2 points on the interest rate. It's crazy. Quick comment, I don't want to get too deep into it, but on recourse versus non-recourse debt, this is very similar to housing. Single family, and David just talked about this. He'll get more into it in the 2-day and explain the difference. But now for a deal of 1.82 million, we have some programs out there that are Fannie Mae and Freddie Mac. They're what's called the small balance loan programs, or SBL for short. And under SBL, they are non-recourse. So it is possible to do deals of this size, anything over $1 million loan, basically, on a non-recourse basis. And that's one of the advantages of multifamily that we have versus single family typically. And then I'm glad you pointed out your capital repairs here, your budget's not that high, but it's because this was a cash flowing asset, not a huge turnaround, but you did do quite a few things to it, and you were able to pay for a lot of the rehab right out of cash flow.
Yep, and yes, exactly. It helped a lot, and we ended up having to put a lot more in because the market in that area shifted, and by the time we ultimately sold this deal, sorry to spoil it for everybody, but basically we had to keep up with the market. The market started, I think it was like $500 and $550 in rent. By the time we sold, we were up to $750. Well, to keep up with that market and that demand, you got to continually upgrade units and upgrade units and upgrade units. And you'll see in the next couple of slides kind of what we had done. As far as financing is concerned, I will say that when you were talking about the SBL, we did actually refinance this into a Freddie SBL to get out of the recourse at about year 2. So, and I think our rate went down to around 4.6. So, and then we were in non-recourse after that.
David, you got something?
Yeah, really quick, folks, so you understand. This is a deal where 2 guys got together and they had a bigger chunk to work with. But Scott, can you do it really quick for me? There's other deals where people put them together because they're listening for the first time tonight and they're like, well, I only got like 50K or 25K, or could you explain a little bit about that for the folks listening real quick?
Yeah, so they mentioned that they met at Lifestyles and they were able to combine their money and they leveraged up to 54 units. We do have other people that might be between the single family and the multifamily deal, but they want to do it themselves, and they may put their money together so that they can move from a 4-plex or a 6 or an 8-plex into a 20-unit deal. So we've got different levels. And then the other thing is you can also invest passively, and I don't even know what the lowest passive amount is. I think I've heard numbers of $10,000 that people have put into deals, but there might be some even lower than that. So does that answer everything that you wanted, David?
Yeah, that's perfect, because I want people to understand we do have people that invest as low as 25K in these deals. And if he makes 100% return, you make 100% return. It doesn't matter. It's a rate of return. It doesn't matter how much you put in the deal.
That's right. That's right. Okay, I think we got all of this slide. Next one, please. All right, so here we have some pictures.
Yep, so the green exterior here, this is kind of how we acquired it from the previous owner. Honestly, you kind of look at the property, it's got a little L shape, flat roof, kind of brings to light maybe this was once an old motel. I mean, so this property wasn't kind of your standard per se apartment complex. It was really a hodgepodge of buildings that I believe the previous owner, or maybe two owners prior to him, had kind of pulled together and made. And actually 8 of the units of this property were literally a block away. So it wasn't like your conventional all-in-one block or kind of property. So, it was different.
I remember 3 pieces to this property. The one on the left was kind of the motel feeling one. The one on the right was the one next door, and it felt like apartments and had a laundry room. And then there was the one down the block that was almost like an 8-plex or something, upstairs,
Correct.
downstairs. Yeah. Okay.
Yeah. So here we go. So most of these, they don't show really the office area, but on the pictures on the right, this is pictures of kind of the 8-plex that was about a block away. And I believe the previous owner had pulled all that in and made it one property. So, but it worked. I mean, you just gave them a number. They reported to the office. They talked to the manager, and the manager kind of showed them, what needed to do to lease, and pretty standard stuff. So.
And here we see the before and after, and with the condition of that kitchen on the upper left side versus where you took it to.
Yeah, that was our first turn, kind of to make our mark. We hired a flooring company, but the maintenance guy painted it. Funny enough, that maintenance guy is now a contractor, and probably one of our most trusted advisors in doing things for us. But he did really good work. He still does good work. But yeah, he kind of just took this, and you see we kind of had to rework the cabinets. We just moved the appliances a little, just little touches to make it that much better.
So I want to point out, this is another thing that's hard to follow single family on. I think it was the first single family that was put up there. I was looking at some of those pictures and I was thinking, good grief, can I move into this place? It looked pretty nice. And in this case, look, this is a Class C in Texas City. I don't know what the rental rates are here, but you can throw that out there. And the model here is clean and functional. We're not going in with granite and all this special stuff and trying to get the price up in this. The value add was just in making that thing in the upper left-hand corner look like the thing in the upper right-hand corner. And you got some rental increase out of that drove an increase on the $33,000 per unit purchase price that you had. But the average house in Houston now, or the median home, I should say, is like 250, 260 grand. That's not where we are with these lower level apartments here, and we're not trying to compete with that. So it's Correct. A different game plan.
Yeah, and the bottom left picture there, that unit was real special. That poor lady, I don't know how long she'd lived there, but they had like a built-in heater. This unit didn't even have central AC. We actually installed central AC into this unit. You can kind of see that she had some sort of bar over here, but they had like one of those built-in old style heaters on the wall. It was pretty crazy, but we spent a tremendous amount of money there. I think that rehab there was 10 to 15,000 after we factor in the entire new central AC, all new floors, new appliances, all new cabinets, everything. But I mean, when you go from $450 a month to $650 to $700 a month, yeah, you do the math.
That's a big gain. And I do see it started with ceramic tile floor, though. That's kind of surprising.
Yeah.
Okay. All right. So let's talk about the financial numbers.
All right. So I believe this was when this was right before, this is when we took over. So the income was about $392,857. Our expenses were running around $219,000. Our NOI was about $173,854. So our monthly cash flow was about $6,200. Cash on cash returns about 12.5%.
Actually, I think we're going to see it one of the next slides, but I think this was the 12 months before you sold it.
Yes.
In September of 2018. Okay. And then we'll compare those to the previous years on a slide coming up. Okay. So what we're talking about here, 12.5% cash on cash return. Again, look, it's double digits. This is actual payoutable cash. But the real goal here, and $6,200 a month divided by 2 of you in cash flow. So that's a pretty good chunk there that you were getting on your $300,000 investment that you each put in. But the real goal here, this was a value play. And this really increased the equity that was in the deal. And we're going to see that on a slide coming up. Okay, so now we're talking about year one, the year that you bought it, the middle year, and then the year that you sold it here. Why don't you take us through this?
Okay, so year one, we were at right around 366,000 in income. Operating expenses were 187. NOI was around 179. You see mortgage and cap expense payments. You could see that first year, basically, we made no money because we didn't bring any money to the table for rehab. We bought the money to acquire the property. Just maybe a different model, but like we said, it was a cash flowing property, and then we took money out of cash flow because we both worked. This was a deal to a value add. So we value added by taking cash flow and reinvesting it back into the deal.
So this is the inverted part about single family, and that is in a single family, you've got to come with all the rehab. You've got to get it all done before you can put a tenant in there, and in some cases, refinance out of your hard money. In a multifamily property where we've got, it was 50 something units in this one, right? So while we're working on 4, 5, 6, 10 units, we've still got the other 80 to 90% of the place that's paying rent while we're working on those. Then once we're done with those, we fill those up. Some more people move out. We fix those up. We rent those for higher rents, et cetera. And you start to roll through the property as people move out, but you're making money day one. You don't have to come with all the rehab up front. You just have to get to the closing table with enough rehab to get started on those first units. Again, the flip part is you didn't make any cash flow in the first year, but you can see then in that middle, just below middle, mortgage and CapEx payment, you can see how that's reducing over the 3 years because they're putting less and less into improvements on the property and just getting down to paying the mortgage, and the cash flow goes up. You also drove up your rental income because you had the rental increases that you talked about on that previous unit, and you drove down your operating expenses from 187,000 in the first year to 160 and then 168 before you sold it, which all drove your operating income up.
Correct. I mean, to get our expenses down, it was pretty, I mean, there was little things, renegotiating the electric or, just doing water conservation, things like that really helped. And then replacing, a handful of air conditioners when they replace R22 going to R410, making those changes will significantly help, because we were also running an all bills paid option there too. So, if a resident comes in and, at this class, they're at a fixed income, right? So if a fixed income, you offer them that all bills paid package, they can't necessarily get the electric rates that for say you and I are going to get in a house. We have more buying power as a commercial property, and we can buy at a better rate. Well, if we buy at a better rate and we sell it to them at a higher price, even though it's still lower than potentially what they're going to pay, we're going to make out pretty big. And we did a lot of that there, and we still do a lot of that today.
And then when you go to all bills paid, you put in low flow toilets, you put in aerators, you put in more efficient air conditioners, and all of that savings drops to your bottom line and your cash flow on the back end. So, if we go to year 3 there, $130,000 on a $600,000 investment, 21.7%. That's huge. And in this case, that's not even the whole story, right? We're going to get to that on a slide that's coming up. And here it is.
So, like I hinted at before, we ultimately sold this deal because we were looking for the long term, right? We could have held this deal and just kind of lived and done what we've done, maybe done a refinance, but ultimately we wouldn't have released all of our money, and being right now at this point, I think I was at 34, 35 years old, ready to just continue on and grow bigger, right? I didn't want to stay in maybe a 50 unit property. So ultimately the purchase price, NOI was 123, year 1 was 180, year 2, 212, year 3, 200. So you could see as we were increasing the income. Well, when you're increasing income, and then like we talked about before, we're dropping the operating expense, which is ultimately increasing the NOI. Well, your property value is ultimately increasing because you're doing that by obviously increasing income, dropping expenses, and it's divided by a cap rate, which is the expected capitalization rate, or the rate of return in which you expect you as well as other people in the area are getting for that property.
And before you ask too many questions on what he just went through, David's going to go through all of that in the 2-day and bring all our lingo into focus for you there.
That was perfect, Scott.
Yeah. Okay, and so let's talk about the equity capture, the bottom line there, because this was bigger than the cash flow on this deal.
Yep. So, like I said, we wanted to roll this into something larger and more in our lives. So the ultimate capital gain here was ultimately realized when we sold the property. We increased the value by, 730,000. Remember, we had put 596,000 in originally. So we're talking 122% return. And honestly, it was less than 3 years. We sold at year 2. I think it was 7.5 or something like
31
that.
months. Yeah, it was 31 months, so just past 2.5 years that you own this thing, right?
So that's how I started out my speech. It's about making 100% return every couple of years, and you did just that. Do you know the technical term in the industry for that?
Nope.
No?
Oh,
Come on, I gotta make an engineer, a conservative guy say it. Go for it. What was it?
peeing your pants excited.
Thank you.
He lost focus, but he's been listening. All right, so let's talk about the sale.
All right. So yeah, we sold in October 2018, almost 2 years ago. Sales price 2.55 million. The proceeds from the sales is 116. Operating cash flow is about 80,000.
That's how much you had taken out up to that point.
Correct.
Okay.
6,200 for 13 months, and reinvested that cash flow for the 18 months for the capex. And then we basically, the combined total ROI was $1.196 million. So you take out the original investment, 596, we've had 101% return in 31 months.
There you go. So double your money in 2.5 years. Pretty good return.
Yep. Like I mentioned before, I partnered with another lifestyles pig I met in 2 days. His name's Alan Yu. How did I basically get the deal? Networking with lifestyles brokers. My previous life, I did sales and networking with Baker Hughes, selling products and services. So it was pretty easy to just basically change industries and do the same thing and network with the brokers to find a deal. The biggest thing with that is, look, you've never done it before. And now you're telling somebody that you're going to go buy this property. Well, you got to basically prove to them that you can do it. And I still had to keep doing that every step of the way that I've gone from this point. But it's just, finding somebody, a broker, a mortgage broker, whoever it may be, to believe in you and know that you can do the right thing. And I think Lifestyles has definitely helped that because you get those people behind you to help you. And then also evaluating and underwriting many deals. I don't know how many we've evaluated and underwritten before this point. I think it was in the 5 to 6 range. And then we self-managed the property from the beginning. That was one thing that we've learned so that we could really learn the business. We didn't hire third-party management. And we've ultimately, we're able to stay away from having to hire third-party management from the day one because we basically told the mortgage broker, hey, look, we're going to just use the current manager, which was the case, and she was already running the property, and they believed it based on a lot of our background that we could continue doing it, and they never had the requirement that we needed to go the third-party route. So,
and I can tell you that we do have Lifestyles vendors from the loan broker standpoint that are very well educated in the program and what we do. And we have gone with them and beyond them straight to people like Freddie Mac on the small balance loan program and made them understand what the Lifestyles adds to somebody's resume and their ability to be able to do this first time management. So we've had a lot of legwork put in to make that kind of stuff happen.
Yeah, I think one thing I want to hit on is, a lot of people, I think one of the single family presenters was saying they basically bought 3 houses in 3 weeks. Just to give you kind of how fast you can make things happen with the right people behind you, is we joined in July of 2015. We closed on this in February of 2016. So within 6 months of joining, pulled the capital together, learned what we needed to learn, and closed on a $1.8 million deal.
That's moving on a multifamily deal.
And another important factor I want people to understand between the difference between single family and multifamily. He was able to deploy $500,000. How many houses would that been? It's ridiculous. You can double $500,000 much easier. One building, one roof. I want folks to understand it. Sometimes they get confused on that. When we start doing the millions, like I'm putting in a deal passive right now myself, like $500,000 in one deal. I can't do that with houses. So I want people to understand that.
All right. How has lifestyles changed your life?
I mean, I'm probably like everybody else that when they join lifestyles, you're like, go to work, get a good job, invest in your 401k, retire, and then die, right? When I sat there in that 2-day, or even just in the financial freedom presentation, it was just eye-opening. It flipped my thinking of finances on its head. And as you see, David's talked about already, and we'll talk about in the 2-day, it was just amazing. It just retrained my mind to think, you as your individual self, never sit down and put together a balance sheet. I had never put together a balance sheet to see what my net worth was before joining Lifestyles. Like I say, it's going to be your report card. How are you doing? Are you getting an A, or are you just kind of getting by, or are you failing? It's nice and it's kind of fun even to this date. I have to do it all the time now, but just putting it together and updating it on a daily basis, and it's really nice. It's also provided me a means of early retirement from corporate America. I am, like I said, already retired. I'm still working as a full-time real estate investor, so I'm not fully retired, but I hope to be one day. And it also showcased how to operate multifamily properties and hopefully build up a large inheritance that I can one day pass on to my children.
So I want to point out that Chris is one person who came in, they did an IRO deal. And since he sold that about 2 years ago now, he has gone on as a lead investor, taking other people's passive investments. And you have 4 deals that you manage now?
I have 3, yeah.
You have 3. Okay. So he's done 3 more deals in the last 2 years, even though the first one took him 31 months. This is a snowball effect, and it's just building up right now. And that's why he's working full-time as a real estate investor, because he has chosen to make this his full-time job. Other people, passives, we've had them retire from their positions wherever they were with oil companies, let's say, and they are living off their passive investments in retirement at this time. All right, what's next?
Short term, obviously, purchase more multifamily properties and continue to grow the business. So like Scott said, I got 3 deals currently. Long-term goals is spend more time with family and retire through passive income. And my picture of my family, wife, and 2 boys there on the right.
All right.
Who's on my team? Obviously, Lifestyles operations consultants. Randa, before her was Christine. They were awesome. Multifamily mentors, Scott, Lee, Carol. I think even Kim McLean mentored us on this deal when we were, driving to Texas City, and he was coaching us through the whole thing. It was awesome, just to have somebody with experience sitting there and just kind of, not necessarily hand-holding, but answering your high-level questions when you're not sure of what the next step should be. We used Tier 1 commercial mortgage for a mortgage on this deal. We used Liberty Construction for the exterior rehab, and then we did use 323 roofing and restoration on some of our interior stuff.
Yeah, sometimes it's hand holding, and sometimes we have to push you off the cliff. I have had to say the words, if you don't do this deal, I will. All right, let's take some
questions then. Okay, I'm gonna give it to David. If you want to see what David looks like, he looks like this old man here. Hold on, put your face over here so you can see.
Where's my face?
There you go.
Okay, there I am.
I just want to see what an old man looks like.
I'm the good looking one. That's how you tell me and David apart, since we have the same name. Why was the financing recourse?
I had no experience. The biggest thing is, when you have no experience, you got to take what you can get. If I remember correctly, it was almost 5 years ago now. They went out to market, just similar they do with insurance. They went to market, and you get what you get when it comes back. Almost all of them were non recourse or full recourse because, like I said, no experience, you know, and so you kind of have to earn your stripes.
We have a saying, your first loan is your worst loan.
Yeah.
After that, it gets better.
And you gotta get to that Fannie Mae Gold card, you know, once you do one recourse.
You have to prove yourself.
So on the sale, did you do a 1031 exchange?
Nope. Okay, here's the crazy thing is
Capital gains tax.
So no, we did not, because we went and bought 635 units and did cost seg, and basically I ended up getting a check back, I think, for $20-some thousand from the government, because my wife and I both at the time had W-2 employed jobs, so it was kind of eye-opening.
So this is kind of crazy, and you'll see some examples of this, maybe in the 2-day. If not, we talk about it in various.
I'll tell you what cost segregation is in the 2-day. So I want you to remember what he just said. Like, he made all this profit, but yet he got money back. So when I get to the taxes portion, I break down cost segregation or accelerated depreciation. Remember, here's a real world example of it.
Great. Hey, in what city are you looking for more multifamily deals?
I'm currently looking in the Houston area.
Are all your deals in Houston area? Just so folks know, listening, because we have people from all across America tonight listening. So
Yeah, so yes, all across Houston. Yep.
And I have a question for you quick, because I have people from California, Hawaii, and they're listening from all over. Now, you've done 3 other deals with passive investors. Are your investors all from Houston, or are they from all across America?
Nope, all across America. I got Hawaii, California, Arizona, Ohio, but yes, all from all over.
So folks that are listening, when you come to my seminar this weekend, it doesn't matter where you live, invest where it makes sense, the best rate of return, wherever that is. It doesn't matter if it's Georgia or Houston or whatever, go by return on investment. That's what's going to determine what's right for you. So I'm just speaking this way so you get the idea. You can do this from anywhere. Okay.
Great. Hey, how much time did you spend at the property in the beginning and then once it was stabilized?
In the beginning, it was probably 3 to 4 times a week. And once it was stabilized, maybe 3 times a month, if that. It really all depends, you know, when things need to get done, you spend that time to make sure they get done. But once, you know, everything's stabilized, you don't have to spend as much time.
Now, it would be good to point out too that you were in a partnership and the two of you had your own specialty. So you were spending more time at the property than Alan was, correct?
I mean, we both shared. I mean, my time was more flexible. So like, cause I was in sales, driving around, and I could, you know, get out when I needed to. But yeah, ultimately that was easiest way.
And he came from the accounting or finance side?
Yep, accountant, yep.
Yeah, so it was a good partnership.
Yeah. David?
I don't believe I have any more questions.
Okay, questions are kind of slowing down.
We got off easy.
Yeah, awesome. Well, I appreciate you guys both coming out, sharing your story. You inspired some folks. You can all step up. You can all do this. Any final words of wisdom to somebody who's new, listening for first time, never did this before? What advice would you give them when they come to the seminar this weekend? Maybe you want to throw in a few words to them, or what was your aha moment or something like that?
If they don't actually take this and they think this is a spoof, it is not. This has absolutely retired me from corporate America, not retired me, but gone from corporate America to self-employment, climbing the ladder. And it is real. It is very real. Take it very serious. And regardless of the price, it's paid off in spades for me. So that's, if I give anyone advice, just do it. Don't wait. Don't regret it.
And I don't know if you want to share this, but I know from the time I joined till, you know, where I am now, my net worth went up. Do you think your net worth at least doubled in the time you've been here?
Oh, easy.
Yeah. Some people go 600% more. So just so they get a relative, doesn't matter if you have 100 grand, $500,000, if you doubled, it's worth it. That's the point I'm trying to make. So.
I'm still trying to figure out how to get my wife out so that I can get her 401k, because that's a big chunk too.
Okay. reach out to a guy, one of our vendors called Henry Novak. Do you love your wife?
Well, she's still employed.
You're not listening to me. Reach out to Henry Novak, okay? It's called a quadro. You can move all of her money, I don't care if it's $500,000, from her to you.
Okay,
And
yeah, I
not pay
did.
the 10% penalty.
Yeah, I did my quadro with mine.
Okay, good.
So I'm kind of curious. I didn't think we could do it if she was still employed. So
Yes, you
I'll
can.
have to talk to him. All right.
Absolutely.
But the question is, does she love him?
Yeah, because she has to love you because you're moving everything into her name.
No, you're moving everything into his name.
Oh, well, yeah.
She's working.
Well, yeah.
So he gets the money and he could run to Hawaii.
Yeah, like in Saudi Arabia.
Yeah.
Yep. Cool. Awesome. Well, thanks, guys. I really appreciate your time. Thanks for giving back.